In the final hours of the August 17th session, a synchronized wave of selling pressure hit the markets, dragging all major U.S. indices sharply lower. Remember, the following analysis and trading plans represent my personal probabilistic view of the market. This is strictly educational, not financial advice. Sudden end-of-day drops like this frequently trap retail traders. The immediate reaction is often to panic sell at the bottom, or buy the dip without understanding the underlying context. To survive tomorrow's session, we must look beneath the surface price action to identify the institutional flows driving this drop. We will build our framework on 3 distinct sets of data: technical price action, internal market breadth, and macroeconomic risk. In trading terms, a systemic breakdown looks like indiscriminate panic. It is a broad-based liquidation where participants sell across all asset classes simultaneously to raise cash. Strategic de-risking is a more calculated maneuver. It consists of targeted portfolio adjustments and hedging by large funds ahead of a known scheduled event. So, looking at the aggressive dump on the 17th, which of these 2 scenarios are we actually dealing with? Correctly diagnosing the mechanics of this drop provides the necessary foundation for a high-probability, risk-adjusted trading framework for the August 18th open. Let's look at the charts. On the S&P 500 one-hour chart, look at the local high near 7,800. From that peak, a steep structural breakdown of heavy red candles takes the index to a 7,745 close. Below, the session's highest volume bars align perfectly with this downward price action. In technical terms, this is volume confirmation. High volume paired with a downward move proves heavy institutional participation, allowing us to rule out a low-volume retail drift. Checking the tech-heavy NASDAQ 100 one-hour chart, we see the exact same pattern. A sharp, high-volume sell-off hitting right at the end of the day. Pulling up the Dow Jones Industrial Average chart, it displays an identical bearish structural breakdown. A synchronized high-volume rejection across all 3 major indices confirms a unified institutional exit, which invalidates immediate short-term bullish setups. Verifying the true nature of this sell-off requires looking past the index price. We have to examine market internals and sector-by-sector performance. This session's S&P heat map shows targeted selling. Mega-cap tech was the primary drag, marked by deep red blocks for Microsoft and Oracle. Conversely, the energy sector shows stark strength, with Exxon and Chevron closing green. Even within tech, Applied Materials posted a 5% gain. This is sector rotation. Capital is actively moving between different risk profiles within the market. Institutions are selling software stocks to buy energy producers. The capital remains in the market, but it is shifting strictly to defensive, cyclical value. If this were a systemic panic, investors would flee entirely to cash, leaving this heat map a uniform sea of deep red. This internal divergence proves that funds are strategically rebalancing. Our next step is to locate the specific external catalyst driving this shift. What impending event forces mega funds to rotate out of high-beta tech into defensive sectors in the final hours of trading? The macroeconomic calendar for the week provides the missing context for this sudden change in institutional behavior. Scanning forward to the high-impact US dollar events, we find our target on Thursday at 2 p.m., the release of the FOMC meeting minutes. This creates a catalyst overhang. An impending high-stakes central bank data release acts as a suppressive weight on market momentum. Large institutions routinely flatten their books to neutralize directional risk heading into uncertain Federal Reserve policy releases. The August 17th dump was a textbook preemptive front-running of FOMC risk. This dynamic frames the exact trading approach we need for tomorrow. Transitioning from forensic analysis to tactical strategy, we now build the plan for August 18th. We have 3 established facts: a broken one-hour markets texture, clear capital rotation into defensive sectors, and a massive FOMC overhang looming over the market. Based on this data, our overarching trading bias for the day is strictly neutral to bearish. Institutional appetite for upside risk is currently capped. This makes the common retail move, blindly buying the dip, a high-risk play. Because upside potential is capped by the macro overhang, our highest probability setups will be on the short side. Let's map 2 distinct bearish execution plans. We begin from the S&P 500 closing price of 7,745. This is the launchpad for tomorrow's potential scenarios. Scenario A is the bearish continuation. The trigger occurs if the market opens weak and immediately breaks below the overnight lows, indicating that downside momentum is accelerating. The tactical action for Scenario A is to look for intraday short setups, targeting the next structural liquidity pools further down the chart. Scenario B is the dead cat bounce. We must account for the probability that the market attempts a deceptive early morning relief rally. Looking overhead, we have the 7,760 to 7,780 previous support zone. Basic technical analysis dictates this area now acts as a critical resistance block. Your tactical action for Scenario B is to treat early rallies with extreme skepticism. Scout for structural failure within that 7,760 to 7,780 zone to initiate short positions. Both of these primary blueprints actively respect the macro overhang by fading perceived strength and riding the established institutional momentum. None of these setups matter without the final and most critical component of this trading plan, defensive risk management. Because the market is trapped in a pre-FOMC holding pattern, price action will likely be violently choppy as it hunts for equilibrium. Your specific risk directive is to reduce your standard position sizing. This is how you survive the inevitable intraday whipsaws. Remember, this framework is my personal read of the technicals and the macro landscape. You are responsible for managing your own risk. Long-term profitability depends on systematic risk management around high-probability data to survive the opening bell.